Imagine you're Emma, manager of Sunshine Hotel, facing a stack of performance reports. How do you know which parts of your operation are thriving and which need help? Today we'll explore performance evaluation and the balanced scorecard. We'll unpack 4 key accounting-based measures: return on investment, residual income, economic value added, and return on sales, and see how running a multinational hotel adds new challenges. Let's dive in. Our hotel manager relies on the balanced scorecard's 4 perspectives. The financial perspective tracks net income, ROI, and even EVA. The customer perspective measures market share, guest satisfaction, and repeat bookings. Internal business process focuses on service time, room quality, and efficiency in launching new amenities. And learning and growth gauges staff skills, training participation, turnover, and IT support. Only by combining these 4 views can we see the whole picture. In our hotel chain, every property gets its own balanced scorecard. For instance, a specific location tracks guest satisfaction scores, room cleanliness ratings, and employee turnover alongside its ROI. These tailored measures ensure divisional goals tie back to the corporate strategy. On the right, you see a table listing financial, customer, internal process, and learning and growth metrics customized for a hotel subunit. Next, we define responsibility centers, each overseen by a manager accountable for specific activities. A cost center, like housekeeping, tracks only costs. A revenue center, such as the reservations office, focuses solely on sales. Profit centers, say the banquet department, handle both costs and revenues. And investment centers, like an entire hotel property, manage costs, revenues, and the asset base. The right center type guides which performance measures we apply. Each center uses different evaluation tools. Cost centers rely on variance analysis and cost per unit comparisons. Revenue centers track sales volume and revenue variances. Profit centers focus on operating income, contribution margin, and return on sales. Investment centers, our focus, use ROI, residual income, and EVA. Remember, those last 3 metrics only work when managers control both income and the assets they invest in. You can't hold someone accountable for return on investment if they don't control those assets. Designing these accounting-based measures involves 3 key steps. First, align your metrics with top management's financial objectives. Second, define the details. Decide what counts as income versus investment, set your time horizon, and choose how to measure assets. Third, establish performance targets and feedback mechanisms. Today, we'll dive deep into the first 2 steps, where the real complexity lies for a hotel division managing its budget and growth. Return on investment, or ROI, calculates income divided by investment and is the most widely used metric. It shows that a $500,000 profit on $50 million in assets yields a 1% return, illustrating why raw operating income can mislead. As a percentage, it lets us compare divisions of different sizes. ROI can discourage profitable projects. If a unit earns 18%, it might reject a 14% opportunity that exceeds the cost of capital. The DuPont method breaks ROI into 2 drivers. Return on sales multiplied by investment turnover. Return on sales is income divided by revenue, showing how effectively costs are managed and how much profit each revenue dollar generates. Investment turnover is revenue divided by investment, measuring asset efficiency. By separating margins from asset use, DuPont reveals whether low ROI stems from thin margins or underutilized assets, guiding managers to the right area for improvement. Economic value added, or EVA, is a specialized form of residual income many companies use. Its formula is after-tax operating income minus WACC times the capital base, where capital base equals total assets less current liabilities. After-tax income reflects true earnings. WACC represents the blended cost of debt and equity, and the capital base excludes short-term financing. EVA shows whether a division creates value above the total cost of the capital it employs. Let's compare the four measures side by side. ROI and ROS are ratio-based percentages. RI and EVA are dollar-based. ROI, RI, and EVA all include investment, while ROS focuses solely on income relative to revenue. EVA offers the strongest goal congruence by incorporating WACC, and RI also promotes sound decisions. ROI risks rejecting profitable opportunities, and ROS provides only a partial view. For cross-division comparisons, percentages like ROI and ROS are easiest. How we define investment can change performance results. Four common methods range from broadest to narrowest. Total assets available includes every asset. Total assets employed excludes idle or future expansion assets. Total assets employed minus current liabilities, used in EVA, excludes short-term financed assets. Finally, stockholders' equity deducts liabilities assigned to subunits. For ROI and RI companies typically use total assets available, while EVA relies on assets net of current liabilities. When we measure assets, we have two approaches: current cost versus historical cost. Current cost uses today's purchase price for an identical asset, giving a realistic economic picture, but requiring extensive market research. Historical cost relies on original purchase price or net book value after depreciation. While gross book value helps compare ROI across divisions, net book value aligns with the balance sheet. However, as assets depreciate, shrinking book values can boost ROI artificially, hiding true earning power. In Step 3, the manager sets performance targets and defines feedback processes. Targets involve comparing budgeted figures to actual results, but budgets must be tailored to each division's operations and metrics. Across all four balanced scorecard perspectives, continuous improvement drives results. Feedback timing hinges on three factors: the criticality of information for success, the management level receiving the update, and the sophistication of the IT system. More critical data, higher-level managers, and advanced IT call for more frequent feedback. Evaluating performance in international divisions introduces complexity. Four key challenges arise: differing economic and legal environments, from political systems to cultural norms, government controls like customs, tariffs, and quotas affecting profitability, variations in resource availability and costs for materials, labor, and infrastructure, and currency fluctuations, inflation, and exchange rates that can distort metrics. To minimize distortion when converting foreign assets to dollars, use the historical exchange rate active at acquisition time, preserving accuracy in performance comparisons. Linking performance measures to compensation shows the balance between incentives and risk. Remember, division outcomes aren't always a manager's fault. A manager might be brought in to rescue underperforming units. Compensation ranges from flat salary with no incentives to full commission without a base. The intensity of incentives refers to the performance-based portion relative to salary. Watch out for moral hazard. When effort can't be fully monitored, managers may underperform. Optimal metrics reward manager actions while excluding factors beyond their control. Let's tackle a practice problem for Piney River Division of MO Corporation. With revenues of $950,000, variable costs of $575,000, fixed costs of $336,500, and average invested capital of $350,000 at a 10% rate, operating income is $950,000 minus $575,000 minus $336,500, or $38,500. Dividing that by invested capital yields an ROI of 11%. Return on sales is $38,500 divided by $950,000, about 4%. Residual income is $38,500 minus 10% of $350,000, or $3,500. Now let's examine Seaside Corporation's multinational challenge. The U.S. division has $7.7 million in assets and a 15% ROI, leaving us to calculate its operating income. The Norwegian division shows 6.84 million kroner in operating income and 72 million kroner in assets, so we need to compute its ROI. We'll also navigate three exchange rates, 9, 10, and 9.5 kroner per dollar, so we can convert each figure accurately. Let's work through these calculations step by step. First, we calculate the missing figures. For the U.S. division, 15% ROI on $7.7 million of assets means operating income of $1,155,000. For the Norwegian division, dividing 6.84 million kroner by 72 million kroner gives an ROI of 9.5%. Next, we compare 15% versus 9.5%, which suggests the U.S. division outperforms, but since the Norwegian figures are in kroner, we must convert both to a common currency for an apples-to-apples comparison. Here we test three currency conversion methods for the Norwegian results. Using the year-end rate of 10 kroner per dollar, or the average rate of 9.5, both produce a 9.5% ROI. The best practice, however, applies the acquisition date rate of 9 kroner per dollar to assets while using the average rate for income. That yields a 9% ROI. By fixing assets at their original dollar value, we avoid inflation-driven distortions and get a more accurate performance picture. Now let's compare residual income using an 11% required return. The U.S. division's ROI is $1,155,000 minus 11% of $7.7 million, giving a positive $308,000. Converted, the Norwegian division has $720,000 in income and $8 million in assets, leading to an ROI of $160,000. This shows the U.S. division not only covers its capital charge but also highlights the performance gap even more starkly than ROI alone. Let's connect back to earlier topics. Cost behavior and CVP analysis explain how we derive operating income for ROI and RI. Budgeting and variance analysis set targets and reveal deviations in performance measures. Standard costing variances roll up into that income number. Process and job costing ensure accurate product costs drive correct operating figures. And understanding relevant costs helps us see why ROI can reject profitable projects, highlighting goal congruence issues. Residual income, responsible diagnostic determine the dollar amount of income left after charging assets their and EVA. The formula is income minus the balance scorecard input robust governance framework that product represents the minimum dollar return while ROI the clear behavioral managers often come for RI because belief systems EVA better align rate purpose define investment methods change active control system however face-to-face dialogue acquisition date priorities prevent together harder than ROI or boundary-based product interactive controls give organizations a comprehensive way to guide performance and foster learning. Supported by 4 levers of control for governance.